You're 69 years old, you're still working with no plans to retire, and you have built up $750,000 in your 401k. The question becomes, should I consider a Roth conversion? That's what we're going to look at on our video today. Hello, my name is John Vandergriff. I'm one of the owners and wealth planning team lead at Blue Ridge Wealth Planners, where we help people transition into retirement with planning, and then also if they're in retirement, make sure that the plans they have make sense, and if not, make adjustments to hopefully help them maximize those years that they have left. And so one of those decisions that we talk about on a daily basis is in the realm of tax planning, and so we're going to look at that today and the impact that that can have on a particular scenario. So before we get into kind of the meat of what we're going to talk about, I always like to cover two things at the beginning. If you like the content, make sure you like, share, subscribe, or feel free to comment to these videos if you see anything or have any questions. But then secondly, if you see the particulars of this situation, don't just act on the information here. We're looking at a very specific scenario. Your situation could be similar, but very different. So make sure you have all the factors on the table. And again, I would consider consulting, a CPA or someone who works in tax planning, or maybe both, to make sure you're making good decisions here. So with this being said, we've got a 69-year-old, still working, zero plans to retire, and $750,000 that is built up in their 401ks. Even though they're still working, should they convert to a Roth IRA? That's what we're going to look at in our discussion. And again, as we look at this, taxes are a very important part, so are investments, but again, we've got to look at the impact of all the things that touch your money in retirement, which is what we do when we sit down with people for planning discussions. And so you'll notice, obviously, where we start at is the goals or concerns you have, and then see the impact that that could have on income, investments, taxes, healthcare, and legacy. And if you've not done work in some of those areas, it's our job to come up with numbers to help you make some good decisions. So we're going to focus on taxes and income primarily today. Obviously, there's more to that discussion, but as we dig into some of the particulars here, we've got a married couple age 69 and 68. This spouse is still working and planning on doing that as long as they live. This spouse is actually retired. So when you see here working or wage income of $85,000 a year, that applies to this spouse. We've got a combination of $750,000 in 401k money, $180,000 in the bank. The spouse here that is retired is already collecting $2,000 of Social Security income, and their income need today is about $90,000 a year. So between Social Security and their income, no need for money taken from these savings. So potentially those accounts are just building and they're saving money into those. And as we said, the key that makes this situation a little different, no plans to retire. So as we look at this, we've got to see, again, basically on these scenarios, is if now is the right time to do this Roth conversion. Before we look at those numbers, we need to understand what goes into making a Roth conversion. So obviously, anytime money moves from an IRA or 401k into a Roth position, that is going to signify a taxable event for that tax year based on however much money moves over. Now, the Roth IRA needs to be in place for 5 years for you to get completely tax-free benefit from those monies. If you do that Roth conversion under the age of 59 and a half, you actually need to wait 5 years before you touch any of those dollars. If you do that Roth conversion after 59 and a half, the principal you convert will be available to you during that 5-year window, but any growth on that money would be a taxable event to you. So again, trying to wait 5 years here is a good thing, but if you need it within the 5 years, only take from what you converted as principal. Don't take more than what you converted. So as we look at this, Roth conversions are definitely the most popular of the tax-free options today. And we're going to look at this scenario and see the factors we need to know before we enter into the discussion of a Roth conversion. So as we said, $90,000 a year, $2,000 of Social Security income today, $85,000 of wage income. Now, one factor that makes this situation a little different is with the working spouse at age 69, when he gets to age 70, that is when his Social Security check will max out, and they will have another $3,200 of Social Security income that will go on top of their income today. So as you see here, they have $109,000 of income now. A year from now, they're going to be in a position where they're going to have $147,400 of income based on the increase that Social Security is going to provide them. So again, we're going to look at this in two scenarios, what the impact of a conversion is now versus what it would be if they waited a year or did it, in perpetuity here. So as we say, current annual income, this is actually the taxable income on the 109. So we're taking off, a little less than $4,000 since Social Security is not fully taxable. It is at most 85% taxed today. So as we look at this, top tax bracket is 12%. Any money that comes out of a pre-tax bucket will be at least 12% taxable and then up depending on how much money comes out. So $750,000 in pre-tax, $180,000 in after-tax, $0 in tax-free accounts like a Roth or properly structured life insurance position. Again, those can work in a similar way. And this is not an unusual scenario. Most people we talk to have a majority of their money in pre-tax. And so the conversation is, if now is the right time from a tax perspective, how do we start to migrate monies from very taxable to hopefully tax-free in the journey as much as we can? So as we look at this, the starting place we've got to consider is where are taxes now versus where those taxes could potentially be later. And the reason I say potentially, we don't know when the tax brackets will change. We don't know where they're going to change to. So instead of doing nothing, we've got to look backwards and say, where have taxes been? Is now a good time considering my particular situation? So like we said, when you factor in Social Security income and wage income, they are within the 12% tax bracket today. As soon as he ages into Social Security, moving forward, they'll actually have their top dollar in the 22% tax bracket. The reason that's important to point out is when this couple gets to age 73, they're going to be forced to take distributions out of their IRA, and that's going to be, as long as he or the spouse is working, at minimum 22% taxed. So very important to understand how those IRA distributions come out and the impact it can have. Now, as we look at this, this is 2017's tax brackets. You say, well, John, why in the world are we looking at 2017? Well, the tax code that we enjoy today is set to expire in the tax year 2025. So really, if it did that, those tax brackets would go into effect in 2026. So we took those tax rates, brought them up by inflation to see where those incomes would be at now. This particular couple's starting tax bracket would be at 25%. And, even with Social Security factored in, both of those checks would be in the 25% bracket. So very important for us to point that out because 25% is larger than 12 or 22 or even 24%. So we've got to factor those into the equation when it comes to if now is the best time to pay those taxes. The last thing we want to look at here, 1981 was a tax year where taxes were significantly higher than what we've gotten used to over the last several decades. As you will look, both of these numbers at 37% or even 39.6 are well below the top bracket here of 70%, noticeably higher. But it wasn't just the top bracket that raised. We have larger brackets at every turn here, some, depending on the income, maybe as much as double where those brackets are today. So as we look at this, for this particular couple, as long as that spouse keeps working, they're going to be starting at, or any IRA distributions at 37%. When you factor in RMDs, they're really going to be pushing that 43% tax bracket for any money that comes out. So as we look at this, this is what will instigate this conversation about if a Roth conversion makes sense. But we also have to look at the math to see if it does actually make sense for your situation. So again, this is a very simple example, but this is something that does, I think, prove very valuable for most of the people we talk to understand what's actually happening when we do a Roth conversion and also what would happen if we choose not to do that. Because this allows us to kind of see the impact that taxes have and why this discussion needs to happen. So we're going to look at two scenarios. One is if they had $100,000 that just stayed in a 401k in perpetuity, what would be the impact? And then if we choose to move that $100,000 into a Roth today, what would be the end impact of doing that decision? So obviously here with the 401k, if we choose to do nothing, there's no tax impact until you are in a position where the government makes you take that income out at age 73. If we voluntarily do this, This is going to add $100,000 of taxable income to whatever income sources they have. And let's assume that the tax impact to your money is 20% for this conversion, and we pay that tax out of this so that it is a fair comparison. You now have $80,000 versus $100,000 in the 401k. Some advisors will stop you here and they'll say, this is why you don't need to consider a Roth conversion, because $100,000 is bigger than $80,000. If the market goes up or whatever you invest in makes 10%, this bucket will make 10, this will make 8. You're making less money by doing this conversion. Why do you want to do that? Well, again, that's a very short-sighted argument, but also not recognizing that now, since this decision has been made, we actually have two different tax scenarios. This is growing fully taxable. This now is growing tax-free, as we said, as long as the account has been in place for 5 years. So assuming that we're investing for longer than 5 years, also assuming that we're investing in the same thing, so that this discussion is truly about taxes, not inflation, time value money, things that really don't matter in this particular discussion. They do matter in the planning universe. So again, if both of these double, the 401k is worth $200, the Roth is worth $160, and the things that we know about the Roth is since we paid all the taxes up front, it's been growing tax-free. You know that this full $160,000 balance is yours, as much or as little as you want to take out. The 401k, it depends on what the tax environment is at the time you take distributions. And for this couple, even though they don't need distributions, they're going to be forced to start at age 73 and then take them in perpetuity. So let's say 20% is the bracket they're at now. What I want you to notice is it's the same as it was at the beginning. And if that's the case, you will notice the bottom line numbers are exactly the same. Again, that's where what we're after in this discussion is what percentage we have today versus what percentage would we have later. That's what's going to be the basis of this decision. Now, the way that we've been trained to think about retirement planning in the realm of taxes is we don't want to pay taxes while we're working. We want to pay taxes in retirement because our income is going to be lower. And if our income's lower, our taxes will be lower. Well, for this couple who isn't planning on retiring, let's say they own a business and they're just collecting income off of this in perpetuity, their taxes won't be lower. They're actually going to have higher taxes because of Social Security, RMDs, and wage income. So again, not every scenario has lower taxes, but even if yours does, there's no promise that has ever been made to you that a lower dollar of income will pay a lower percentage of tax. That's just an assumption that we have. So, but if that assumption turned out to be true, we've got to look at this both ways. You would actually have more money leaving it alone, not converting and growing tax-free, because the price for entry to the Roth was more expensive than the exit point of your 401k. Now, I think this scenario for most of the people we talk to is not likely to happen because of what we talked about. They may have more income, but even if they have less income, because of the overspending that's happening in Washington, the $1 trillion of debt that we carry as a government, that's going to put a lot of pressure for taxes to have to increase in the future. And if that does happen, again, it's going to impact the 401k, not the Roth. The Roth has already paid its taxes. So as we look at this, if taxes go up, your tax grows from the 20% that we started at to 30% when you get to retirement. You notice you have less money coming out of this 401k than you would if you made that Roth conversion now. So it truly does matter when you can pay the lowest percentage tax. And again, since we don't know exactly what the future holds, we have to look at this and make educated decisions of if now is the right time to do this. So based on the knowledge and the information that we have, that starting distribution today would be at 12%. Next year would be 22% with the addition of, a little over $3,000 a month of Social Security income. It would be at 15, actually 25%, both scenarios, but I was trying to be generous here. Both of these numbers are bigger than both of these. So again, it would behoove us to pay attention to this and try to convert somewhere less. And then if things got as bad as 1981, 37 and 43 are noticeably higher than either of these scenarios. Now, realistically, I think what may be reality could be between these two brackets, depending on how much more debt we carry, but we don't know. And when you've got money that's 100% exposed to this, you want to be conservative in your assumptions and try to assume, in some cases, worst case scenario. So if we look at this, And our goal, based on this particular situation, even though they're working, I still think for this tax year, this is looking at age 69. Obviously, the plan would be a little bit different the next year since they would be starting in the 22% tax bracket. But as we look at this, fully maximizing the 12, fully maximizing the 22, and then, these numbers are maxing out the 24% tax bracket. That would convert 282,000 of their 750 today. You would think over 3 years' time, that would be able to get every bit of their 401k done, and then they wouldn't have to worry about RMDs because they would fulfill that before age 73. So as we look at this, if we did this much of a conversion, the effective tax rate would be at 22.9%, which would be less than 25% or any of the numbers we looked at. But we do have to recognize the impact that this could have on another factor. Anytime we increase our taxable income, once you're over the age of 63, Medicare starts to come into play as far as the annual cost of your Part B premiums that are deducted from Social Security will actually go up over that time if you raise your income. So in this scenario, we were going above 366. That would be a cumulative increase of $8,700. The way you have to look at this is you've got to add whatever these numbers are as a tax on top of the cost of conversion. That way you have a true cost of conversion. So that tax could bring this scenario up from 22% to pushing 25%, but that's the things that we've got to look at when we go into this discussion to see if this is the best move possible. You've got to consider all the cost of making it and see if it's a good decision. If it is, do it. If not, maybe it makes sense to wait. But for this particular situation, they're going to have a noticeable income increase in 1 year. And even if he stopped working, he's still going to have a pretty substantial amount of income that we've got to pay attention to. So this is considering if he fully retired, they would be in a 15% bracket just counting their Social Security. So again, I still think this particular scenario has got a lot of reasons to start that migration process today. But again, we've got to factor in not just the variables we looked at, but all the variables going into a particular situation. And so if someone's not shared at least this much with you about tax planning, the reality is you may not have somebody to help you there. And again, they probably won't just out of the blue start sharing some of these things. So you're going to see a link pop up here. I would invite you to click that link so that you can get access to our calendar, talk to one of our wealth planners here. We are all fiduciaries. We're going to look at your particular situation and give you the best advice that we can. And again, factoring in as much of the information that you have going on as possible. And so as we look at this, click that link. We're happy to talk to you, see what we can do to help. Hopefully you enjoyed our video today and the content. As we said, if you got questions, make sure you comment below. Subscribe to this channel so that you can see more videos like this, because again, we're releasing these usually weekly. But until that time, share this with other people that may need help, because the reality is most people today are not having this discussion, and you can see some of the impact if we don't have this. It ultimately affects the savings that you have and maybe the longevity for your retirement. So we look forward to speaking with you in the future. And again, thanks for paying attention and watching this video today.